Hello, everyone. The war in Iran. What does it mean for the United States, and will the Strait of Hormuz ever get straightened out? Non-farms payroll on last Friday gives a negative report on jobs. Could this be the beginning of a recession? We don't think so, but we need to look at it honestly. And GI, DS, our two remaining portfolios, we will go into in great detail so that our clients can understand just how we're managing their money now in war times. From Chicago, it's Thursday, March 12th. I'm Charles Brown, your portfolio manager, and this is CB3 Live. We're glad you're with us tonight in what is a really unusual time, in that we have not been in an undeclared war like this in quite some time. The president says it's not going to last that long. There are many people that disagree with that. But this program doesn't really cover political events, except in that how they relate to us as investors. So I want to say right off the bat, a little shout out to my two sons who took me out for my birthday a week ago and got me this brand new pen over here. I think it's off camera. Actually, I need to sit up straighter. A set of 4 new American flags that I'm proud to have on here in war times. Guys, don't be concerned. You're going to be encouraged by what I show you tonight. Even today in the market was down. The S&P 500 was down 1.52%. And those of you in CG were down 0.09. Crazy, all right? Why is it so? It's the options hedging. We're going to cover it in great detail. We did it last month. We're going to do it again this month. So let's move forward. And we're going to talk about always adapting. That was our theme last month, but this time it's a little more fine-tuned, called Structured for the Storm, because we're clearly in a storm in war times here. So the non-farms payroll shocker I mentioned in the opener, consumer price index implications, CPI came out relatively flat, but what does it mean for the Fed? That's really where this plays into it. And structured for the storm, when markets get violent, structure wins. In other words, the structure of your portfolio, how we're doing that to navigate this chaos. We'll look at GI, we'll look at DS, what's been added, what's been subtracted, what's been reweighted, and we're glad you're with us. There it is, economic data, GI, DS, and choosing signal over sentiment. We look at the math, we look at the numbers, we make adjustments based on giving you the highest weighted return that we possibly can. That's risk-adjusted weighted return possible. That's what we do here at CB3 Financial. We've been doing it 30 plus years now, and we continue with this show. All right, here we go. The monthly market review. First of all, the employment scenario. February non-farm payrolls down 92,000, a shocker. Is expected to be about up 130,000. So the market, for once, actually at least intelligently reacted by going down with bad news. So lost 92,000, 59,000 expected, but that's at the W3 level, all right? So U3 level, I should say. I'm sorry, the U6 level was much higher than that. Healthcare jobs lost a lot. Federal government shed jobs. Nobody cares about that, right? Down 330,000 since the October 24 peak. Wages had a beat though, but we're starting to see stagflationary signals, and this will play into how the Fed wants to address this. And as you well know, we will have a new Fed chairman now in 2 months. And it's going to be interesting to see how that person handles it differently. Kevin Warsh handles it differently than Jay Powell. All right. How do we absorb the shock? We'll get into that when we get into GI in just a little bit. So the wage growth, this was the good news, 3.8%, expected 3.7. That's a tiny tiny growth increase, but at least it was up as opposed to the unemployment rate, which was also up. But you want the unemployment rate going down and the wage growth going up. So this is one of those Goldilocks returns where we have good and bad. That's why the two different colors here. The Fed cannot cut with wages at 3.8% growth. So we like seeing 3.8% growth, but if that happens and the core inflation rate remains above 2%, that means that much of a chance on camera, that much of a chance of having rates get cut during that particular month, because wages increasing generally means that that's an inflationary trend. And if the CPI is also inflating, the Fed's just not going to cut rates. They're not going to do it. So non-farm payrolls was a shock. I said, but what does this really mean? So healthcare down, manufacturing, federal government, transportation, warehousing, social assistance went up, but that's not enough to offset the rest of this. So on the right-hand side, we have a hot with the wages hot, all right? That's a job miss, meaning that stagflation warning that I just mentioned, and that the Fed simply cannot cut with a 3.8 wage growth and CPI hot. So jobs cratered, all right? That's the cool thing, all right? But the wage surge, that's the hot thing, all right? The worst combo possible, the Fed's stuck. Maybe one or two rate cuts this year. Just 4 or 5 months ago, I was showing that what they call the dot plot, or the Federal Reserve projection for cuts in the following year. We're already starting to see projections for 2027, believe it or not. But that projection has dropped back from 5 cuts to 1 or 2 cuts because of this data. So the good thing is the hedges are working. I'll spend more time on this as we go forward. We've made allocation changes, and we will cover that as well. So inflation, the next hottest topic for everyone. We are glad, I'm going to come back on camera and just say this, we're really glad that you guys are starting to answer those surveys. We had 15 answers to our surveys. Let's set another record this month. When you get the survey that Heidi sends on Monday, please fill it out, because there are going to be a lot of questions we really want you to answer. I think you can do it in 90 seconds, though. It's just click, 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 all right? But it tells us which segments are useful to you, which segments need to be expanded, maybe which sections need to be shortened, and also on these portfolio reviews, how often do you want them? Because it takes about 20, 25 minutes of my show to review a portfolio. I was thinking maybe we would rotate them, like maybe 4 times a year, we would do all 4, or we would do one of the 3 major programs alternating months. So, January and April for CG, February and May for GI, etc. Let us know. You don't have to think about it now, but when you get the survey, okay, do fill it out. So inflation, remember, we're looking back. We don't really know what March inflation is yet, but we do know that the Feb inflation number was projected to be 2.4, and it was 2.4. So that's at least good. It's bad because it's high. It's bad because we still have tariff risk rate, because Trump, even though he didn't like the ruling from the Supreme Court, decided he was just going to use a different clause in the law to be able to enforce his tariffs. Is anybody really surprised by that, including the Supreme Court, especially when Neil Gorsuch, one of the 3 conservative justices, pretty much laid out, here's how you can do this. Well, thanks, Neil. We already knew that, and Trump knew it, but that was your tacit way of winking at him, saying we can't okay this, but we can okay something else. You just can't have them on for 6 to 8 months at a time. So all of this plays into, folks, the CPI, the Consumer Price Index, with inflation rising. All right. So inflation snapshot, CPI is measuring the cost of a fixed basket of goods and services. Just as a reminder, core CPI strips out food and energy, and that's the Fed's preferred gauge. Now you might say, well, if you strip out food and energy, any CPI number could look decent, because shoes and refrigerators and skateboards going up in price can't really matter that much, because they're all discretionary, where food and energy are not. You have to be able to drive, and you certainly have to be able to eat. But the Fed still prefers that over the overall CPI rate, simply because the Fed thinks that when you strip those out, which are mercuric up and down every month, it's a more perfect indicator of what sentiment is in the U.S. All right. So tariff pass-throughs, the wild card, I just mentioned that earlier. Shelter actually easing. So shelter meaning rent and home sales, easing meaning that We're not seeing increases there. And that's good because that is generally, certainly homes are the biggest expenditure that we make, most people's largest expenditure. And rents, if you're not owning, is normally going to be 1/3 to maybe even 3/5 or 2/5, I should say, of your monthly expenditures. So if those costs are easing or not increasing, that is a plus for CPI not increasing as well. All right. So CPI components, we got shelter, just mentioned that, 36% of CPI, which is about the target for most Americans of what they're spending to live where they're living. Food at home, food away from home. That's still increasing. I'm kind of amazed in these inflationary times that people are still eating out more, but they want the convenience, and I get it. I totally get it. It's a busy day. Nobody wants to cook. Nobody wants to clean up. So you just order in, and it shows up at your door, and away you go. So energy, a little bit. That's going to change. That's going to change. This data, remember, is from last month. That's before the war was declared, and crude oil rocketed up higher, well over 100. I think it hit a peak of 120.57 on the markets there. So, all right, medical care, transportation services. It's hot. The Fed implication is that the core rate is still too hot. It's in line with where it was, maybe one or two cuts, but that's a maybe. There's nothing saying, oh, yeah, we're definitely going to do this. Now, if we continue to see cuts in consumer price index, then the Fed will then be opened up to cut more rates going forward. So the trend here, you can see starting back in June 2022, obviously this is when Joe Biden was in office, managed to drop. Trump takes office in January of 25, and there we go. So, it's decent. It's just not, that green line is 2%. That's where the Fed's target is. That's where we need to be. All right, so here we go. The three people in the news, two of them are at least alive still. All right, this is what is rattling the world, rattling markets. And I realize there's too much on the screen for you to see in one shot. This is your time to take a screenshot and save it to your clipboard and look at this. I thought this was a really outstanding first 24 hours of what happened. Feb 27, Feb 28. That's a very cool day for D-Day. All right. 1,000 Iranian targets struck. Again, this is a financial show. So what does all of this mean for us as investors? The market's hidden variable is that the Middle East conflict threatens the Strait of Hormuz, as I've been alluding to in my comments thus far. U.S. foreign policy shifting, alliances and sanctions in flux. And that is because we took this on with Israel, not necessarily with support, certainly not even from all Republicans, and most Democrats are not in favor of it, essentially zero, except for the one senator from Pennsylvania, Fetterman. All right. So our European allies, not necessarily all on board with this either. Then you've got the French and the British saying, well, good luck to you guys, but we're going to stand aside. And that's probably just as well, actually. So again, this is where our active hedging and defensive allocation, it hasn't chased us out of anything. If you recall, I mentioned that in April of last year, we had the first tariff tantrum when the market dropped 20%. And by the way, we're not even close to that. Not even close to that right now. It just always feels worse when you're going through it. But we're not going to get shaken out of anything because of the hedge protection that we have, again, coming up in just a few minutes. That will be completely explained to you. Again, I did it in CG. A little different take in GI for those clients that have that program. So crude oil at 94.96. Again, if I'd done the show 2 weeks ago, it would have been much higher than that. The fear index, VIX, hovered around 30 for a while, now back down to 26. But, we like to see the VIX between, 12 and 14. I mean, that's ideal. So defense sector, ITA up, and gold, obviously a safe haven there. So this is the immediate market reaction from crude oil, the defense sector, which I covered, gold, the S&P 500, obviously selling off because of unknowns. The thing about the market, you'll see this going forward tonight several times. The market doesn't even mind bad news. It doesn't like uncertain news. If something happens, and that's what happened during COVID, nobody knew, is this going to be the blue bonnet, that's not right. Whatever that plague was, I'm sure Jay will type in the chat box and help me out here. but a massive plague that was going to wipe out humanity. And the markets don't like that at all. But once it was settled 5, 6 weeks later, then the market just rocketed back up. That could happen here. Sorry for the bad pun with rocket. If the Strait of Hormuz, which transferred, did you know this? That 75% of all the fertilizer in the world, that means for plants and agriculture, travels through the Strait of Hormuz. I did not know that until just earlier today. So that's why this is such a sensitive area and commerce affecting area. I'm trying really hard not to be a political commentary here tonight, but we have to be at least watchful. I'm not going to say worry. We're going to be watchful of these trends. Okay. Bubonic. Thank you, Doc. I appreciate that. Or whoever did it. I can't see who's in the chat here. So anyway, all right, guys. So what's still unknown? Well, a lot, but the Iranian retaliation scope and what they really have the capacity to do. They're saying we're going to double down. Basically, you're not going to do anything that's going to shut down our country. 20% of the global oil supply transits daily through the Strait of Hormuz. All right, so any closure is an energy shock. And part of this is because with the shutdowns in energy production during the Biden administration, Donald Trump has overridden a lot of those, sanctions that were not sanctions, but curtailing of development of energy in the U.S. Okay, but he hasn't been able to get all of them because he's been kind of busy for the first 15 months that he's been in office. All right, so we have not fully ramped up from Alaska and now Venezuela, right? So we have supplies in Venezuela since we pretty much just assumed control of that country, and they're paying us back for the oil that they stole from American producers, but I digress. There is oil out there. We still need the Strait of Hormuz. I would love to see this particular geopolitical event reduce our dependency as Americans on products being shipped in the Strait of Hormuz. That's the best case outcome for me. So this duration of engagement, well, we did have a surgical 24-hour strike, and you'll see that 5 or 6 slides back. All right. Or is it going to be a prolonged theater operation? I don't think so. All right. As I said earlier, markets hate uncertainty more than bad news. The first 72 hours are always the most volatile. I would say that mainly because I'm seeing not every single newscast start with a war story now. They're covering other news that we're kind of, I don't want to say anesthetized already, but let's face it, the Ukraine-Russia war in the 4th year now does not start off as the 1, 2nd, or 3rd, or maybe even 4th news story. What is going to happen here, according to the president, is we are going to make it possible, or impossible, I should say, for Iran to develop nuclear weapons or even to have first strike capabilities. And we will keep working until we get that done. So in light of that, I thought it was appropriate to continue this theme. I've never done this actually in 7 years. Always adapting. We are always adapting to markets. Our ability to react is much, much more important, and I'll call it to adjust, than it is to predict those markets. So that is why we are always adjusting, and we are structured for the storm. We could see it in indicators that I've never shown you. Options hedging indicators. I'm going to do this maybe next month, maybe the month after. I'm not sure because they're kind of geeky, but I think it's important for you to understand that we are watching a lot of indicators that most people in this business, that would be the wealth managers, are not watching. Okay, they're just not. But those of us that are traders and actually trade the other side of these options that we're using to hedge in your portfolios and mine, but we're actually taking the other side, which is the speculation side, we have to have a real pulse on where options are, and options markets tend to lead equity markets and even commodity markets. So here's the year-to-date scorecard. It's a down year. We're probably going to finish the first quarter of the year down. I'll just tell you right now, when you're behind at the end of the first quarter, it's unlikely that the year is going to finish in double digits. It certainly could finish in mid-single digits, which after the last 2 years we've had, really isn't that all much to be upset with. Sorry for my colloquialism there, but let's face it, we can't have every year be 23%. All right, NASDAQ down much more. 10-year yield, just can't give it back at all. And yeah, I see it now. You just wrote in there, Doc. I don't know who this viewer is. We have a new viewer here. I don't recognize eating out of it. Question. Yeah, reserve it for special occasions. That's actually a good idea. I try to comment here. The show is going to be unusually long, and if I don't get around to commenting to all you guys at any rate, but yeah, West Texas Intermediate at 96, 95.55, whatever. I mean, it's in that ballpark. But the reality is, guys, we are just in a time when the VIX is at 26, anything can happen. The VIX doesn't live at 36 or 46. Those are just multi-hour spikes, and we haven't had that yet. We did have that last April when it looked like, again, that the tariffs were going to unravel everything and pull off basically another COVID experience, but it didn't happen. It actually only lasted about 7 days. So, but it still knocked us out of some positions because if we hit those levels, we have to take those stops because we don't know where the bottom is. Okay, we don't have to do that now because we have the options hedging, which I've been telling you about it, and you're going to learn more today. All right, so 2GI, what is this program? This is our most conservative of our 4 programs. It is labeled GI because it's growth at income. You can see it at the top there. The core satellite of this program is SPY, which is the S&P 500 at 40%. And then we have equity satellites. I introduced the concept of equity satellites in the last month's show for CG. We have fixed income. This is the only program. That's actually not true. MP has one tiny fixed income asset in an ETF. This program has the most. Why? Because the people that are invested in this program are using it to draw income. And we pull income as we draw down the account from the fixed income holdings, and then we rebalance at the end of every month. So why do we do that? Because if we are in a downturn, we don't want to be pulling money from the equities or the satellites, right? So, and this program does have an options hedge. All programs of the major 3 programs of CB3 Financial do have options hedges and 1% cash. So 7 to 19 holdings across equity, fixed income, options, and cash. So in many ways, this is the most diversified of our portfolios. And there's a good reason for that, because when I started doing this with you guys, we were all in our 30s and 40s. All right. And now 25, 30 years later, the present company here got a low 7 on my handle there. And some of you are older and some of you are younger than I am, but it's just a different world when you are retired, which I'm not, but many of you are, and you just don't want to see a 50% drawdown like we saw in 2008. Now, we didn't have it that bad. We were down 38%, but who wants a 38% at this age, right? The way to mitigate this is with careful asset selection and with options hedging. We have a dividend yield of pushing 3% here, guys. We're really happy about that. All right, and a nitrogen risk of only 71. So the maximum risk in nitrogen is 100. If you remember last month, CG is like 90, and you're going to see the DS is way up there. But a 71 on this portfolio with a 2.9, and it's the only program of our 4 that is positive for the year. How about that? So performance since inception, 2024, which was, beating its benchmark by, I don't know, almost 500 basis points there, 470. Okay. So we're adapting. We're adapting for what we need to do for whatever the market throws our way, whether it is a really ugly non-farms payroll or whether it is a war. And by the way, tariffs. And by the way, new tariffs that don't take into account the law that the Supreme Court said you can't use. So all that happening simultaneously just brings unbelievable drama to this administration. So let's go forward here. Here's the restructuring. 7 of the 12 equity satellites were financial stocks, and we have reduced that. All right. So that exceeded the limit that we wanted, and that's because some of them had grown to that point. So we had no direct international exposure. We've changed that, and we exited the banks that were not working as well as JP Morgan, all right, and others, such as BAP, which you'll see in just a minute. Okay. This is not because they went on a sell signal. It's because we found better choices. So we can make choices in our portfolio, not just if a sell signal is hit, but if a less than ideal buy signal is not optimal, and we see something else in a different space applicable or applying to the current environment, and that would be wartime right now. So we have to look at defense. We have to look at all kinds of things. All right. Risk concentration, not a conviction of any individual position. So what did we do? We reduced the financials from 7 to 4. The concentration dropped to 33% of the sleeve, which makes sense. We added RTX. Okay, so that's Raytheon and United Technologies. That's that merger together. Aerospace and defense. EEM, which is emerging markets, and that pays dividend. And it's a 40% return last year. We didn't have that 40. We weren't in it at that time, but we got into it earlier this year. EPOL, which is what we think is the strongest emerging economy in Europe, and that's Poland. Why? Poland is right next to Russia, and they are the most eastern of the European Union countries. Okay. So they have a vested interest in protection, and we have a vested interest in them prospering. Not that we don't want everybody to prosper, but let's face it, we're pretty much myopic in looking at our own self-interest right now. So SPY increased to 40%. SPY was targeted at 40%, but with the market getting hit, it dropped. So we will rebalance SPY every single month to a target of 40% because we want to capture that beta from all the stocks that are in SPY that we don't have in our portfolio. That's the structure of a core and satellite program. You get your basic returns in SPY, and then you add your satellites in different sectors, in different industry groups to pick up that extra alpha over and beyond what you're getting from the market. Okay, so here's what it looks like. SPY at 40, these light blue or light green, whatever you see on your screen, Brooklyn, HYG, Scooby, forgive my acronyms here. Those are the fixed income components, and then you can see all the stocks there. We're going to go through every one of these so that you know what you have in your GI program. All right. First thing, we exited Morgan Stanley. Everything's on a buy. We didn't do it because it failed us. We had a good profit on it. Same with Bank of America, same with PNC, but we just did not need this much financial concentration, especially with the dollar's volatility. So again, we did not override signals. We just found better opportunities, which we're going to describe right now. So this is a long list. Okay, this is kind of like graduation. You know, you want to go hear your kid go up on stage and, Johnny Smith graduated, but you got to suffer through 2.5 hours of everybody else's kids. All right, well, these are all your kids, all right, but it's still a long list. So what I'm going to suggest to you, if you don't want to see everything on the screen, look at the screen here going forward and just look at the bottom, the core rationale. All right, so SPY isn't a hedge, it's the engine. Okay, and if you want to come back and clip this, you can and make screenshots, or I am making the PDF available. I was stunned that about 6 people, which is a lot for us, asked for a copy of the PDF. I'm happy to send you the PDF of the slides. This says that SPY is up year to date 1.1%, but that is not true, okay? I just can't keep these slides up. Once we're creating a deck, I can't keep it up to date every hour. So that is actually down, but this is the core holding in the portfolio. Next is Boeing at 2.5%. Again, good year to date return. Boeing provides the aerospace exposure with a compelling asymmetric recovery story. It's basically in a duopoly with Airbus. So it's just those two companies because they're both gargantuan and they have what's called a huge moat. I mean, a monstrous, like 3-mile high moat that nobody can get over because the just huge capital intensive nature of what they do. And the fact that the governments are using both of them playing off each other. We have one that's American, one that's European. And so there you go. We like Boeing a lot. It's the bigger of the two companies. BAP is a Peruvian financial services company. So we pick up a little bit of interest rate credit risk there or interest rate credit gain, depending on how you look at it. Year-to-date return, we love this, 12.5%. Wouldn't it be great if everything in GI at 12.5%? But you get these winners from time to time, and it tends to pull along the others that just aren't having their growth spurt right at that moment, all right? That's why we have these diversified satellites, because you've got this one, obviously if we'd known it was going to be up 12.5%, we would have had 9% holding in this. Never much more than that in GI, but It's our highest conviction satellite. Why? Because it has a very small PE ratio with a 4% dividend. That's crazy. To get a 4% dividend, you're usually paying a PE of like 23 or something. All right. But it's a foreign company. Okay. And US banks simply can't replicate it. So that's why it's in the portfolio. Bank of New York Mellon, this is the primo bank here, actually, other than JPM, but this is a holdings company. So people clear. This company competes with Charles Schwab, who is the company holding your assets. So BK anchors our remaining financials exposure with the lowest correlation to interest rate swings, whereas JP Morgan will have interest rate swings, not so much for Bank of New York, because again, they're custodian and they have management fees monthly that come in from their asset managers. Okay. So not net interest margin risk. Caterpillar, I think the de facto industrial here, 3% weighting. Infrastructure spending is a beneficiary. Data center construction, 2 out of 3 channels, strongly long. That's on the technical side. But I think it's the ultimate pick and shovels play. That's what I labeled it for U.S. infrastructure and AI build out. We are not anywhere close to being done with this AI build out. We might not for a decade, but certainly for the next 3 to 5 years. CAT is just really positioned well because you need these big heavyweight machineries. I mean, John Deere has some of it, but CAT, there's nobody that competes with CAT, and that's why we're here. It's trading at 17x, so it's very reasonably valued for sure, and a decent dividend at 1.5%. EEM, this is the Emerging Markets ETF. So we're in this because we haven't had any foreign exposure and we wanted the dividend from these 1,400 stocks. I don't think every one of them has a dividend, but many of them do. We needed instant international exposure once this war hit. And so that's why we made this change. All right. So 13.7 is the PE ratio. Again, we're getting global diversification at a 50% valuation discount by our math. And that's why, we just think this active management is necessary. You've got to be able to respond to that. And in line with the same sort of thing, we have EPOL, which is the Poland ETF. Now, I just said a few minutes ago why Poland was so important. Well, we think they're so important that we're investing literally in a country-specific ETF. Normally, this would be done in CG, not in DS, but in CG. But we're doing it here in GI because we feel so strongly that with a PE ratio of 8.2 and a dividend yield, that's why we did it. And we have international exposure. We have a low PE ratio. What does that mean, low PE ratio? Well, it means it can creep up from 8. What was it? 8.2? Yeah. Okay. 8.2 to 9 to 10 to 14, whatever, and take the price with it. And it's still way under the S&P 500 average PE ratio. All right. So that's why we looked at this and why we're really happy it's in here. Love that 4.4 dividend. Poland sits right at the crossroads of European Union structural investing and NATO defense spending. Some of that with Boeing. All right. GE Aerospace, just a great company. It got whacked 2 days ago, like down 6%, but then it was back up again today. It's our top performing satellite year to date at 14.8%. Year to date, folks, we're like, in the second week of March here. This is pretty amazing. They have a backlog of inventory. And since this isn't a cyclical business, that backlog stays, okay? And that's why most stocks can't match this because they run their business in cycles. And it's not that they choose to, but they have products that when things are not good in the economy, discretionary products like cars, people just stop buying them, or real estate, they just stop buying. All right. But if you need what GE offers, you're going to be buying it. All right. And they're working in aerospace. All right. It's not a trade. It's a thesis. We love this stock. Johnson & Johnson, another one we love, right? Year-to-date return 7.8. I mean, 7.8% when the S&P is down almost 3%. And it's a snore company. I'm sorry to insult you, Johnson & Johnson, but nobody gets excited, like Palantir or something. We're talking about Johnson & Johnson, but look at this, 7.8%. It's a 16 PE, which is, certainly higher than the ones I've shown you, but it's got a dividend of 3% and a relatively small market cap of 425. All right. So it provides the defensive anchor in our equity satellite sleeve. Although tariffs can't affect it, we feel very strongly this is going to be a hold for a long time. All right. Richard D. University of Florida. I don't know this text. If you want to identify yourself, we'd love to know who this is. I don't like the chart on AT&T. I don't like AT&T or Verizon. I haven't for years because they're such a commodity. They're almost just sitting there waiting for somebody like T-Mobile or to come along and take them out. I'm just not. I want to see a chart that's going up if I'm going to invest in something, and I still want a good dividend. And I'm showing you stocks right here that are paying great dividends, and their charts are phenomenal. Rockwell Automation. This is just a phenomenal stock. Not a great return year to date so far. High PE ratio. Not a great dividend yield. However, it sits at the intersection of two mega themes, reshoring and automation. Reshoring is when people that have moved companies and production and plants to other countries reshore and bring them back here to the US. And that is a huge movement. And Rockwell Automation is part of that because it's tooling up their factories. All right. We think tariffs will force manufacturers to bring production back to the US, and they must automate to stay competitive on cost. So Rockwell provides the software and hardware to make this happen. We love this holding. It's rock solid. That snuck out, guys. Forgive me. Okay. RTX, again, Raytheon and United Technologies. So geopolitical defense spending cycle before because this was before the Iran strike, was already a strong buy. And it benefits now directly from the Iran conflict as rising NATO spending has commitments, and they're going to benefit from that. I mean, you just want to be where the right places are in the economy. And that's what we're doing. We're rotating to find that. It's a relatively small market cap. It's still a large cap company, but not a huge dividend either. And the PE ratio is high. It's the highest PE ratio we have in GI, but we love the space and we think it's appropriate here. And Truist Financial, I actually mentioned this company last week. These are the guys, you remember the chart last month, where they said, oh, by the way, we have all this financial planning software. You're not going to need your wealth manager anymore. And then we gave a little dissertation on the difference between a wealth manager and a portfolio manager. If you did not see that episode, please, when you're done with this, before you turn on your reruns, go back and watch the February show, because Truist was a company we highlighted. And of course, we have them in our portfolio. 5.2%, great return year to date, low PE at 12.0, crazy high dividend yield at 4.75, 4 3/4, and a market cap 68 billion. I mean, that's not a mid cap, but it's just at the very bottom of large cap. So we think it's the cheapest financial out there. It's certainly the cheapest in the portfolio. And it's our income workhorse in equity sleeve. So it's an equity. It's not like the fixed income, which we'll get to in just a minute. But because the dividend is so high and the PE is so low, it acts as if it were fixed income. So that's kind of the, cleverness of the portfolio. We're able to find some of these rare stocks that actually have growth, but also really consistent income, almost comparable with a fixed income asset ETF. Okay. So let's run through the 4 fixed income sleeves. So we don't have this in CG. We don't have this in DS. But if you're going to have a growth and income portfolio, you got to have income. And the way we get it, first off, is I call it Brooklyn, but this is floating rate senior secured loans. All right. It's a 7% holding. Now, the reason we have this higher is because we can have fewer holdings. All right. And still be very diversified, because there are just thousands of different bonds inside this program and the other fixed income ETFs. Year-to-date return, not that much, but it doesn't need to be, because the yield on this is 7.4%. Okay. Really strong. Okay. So floating rate structure means we benefit when rates stay elevated. Being senior secured means we're first in line if a borrower runs into trouble. So if rates plummet, and I haven't seen any signs of that for the last 3 or 4 years. As you well know, if you refinanced your home 3 years ago, you paid a lot more for it than you did if you refinanced 6 years ago. So that's why we like Brooklyn. HYG is actual junk bonds. Now, you might say, well, why would anybody buy junk? Well, because junk is a relative term. These companies are still solvent. Their debt rating is just not reviewed as highly by Moody's and S&P Financial, et cetera. So these are still good quality bonds, and a 5.8% yield, only 1% return, but look at the yield, and that's just pouring income into your account and does contribute to the total return, all right? A relatively high expense ratio, but worth it, we think. So it's rounding out the high yield sleeve. And again, this and Brooklyn together are pretty strong, generating about 6.6 to 7% of income. So Scooby is the corporate bond. So we have general government bonds, we have junk bonds, and we now have corporate bonds. So everything in here is issued by a corporation and not a U.S. or other government, all corporations. Okay. Again, yield to date return, not a whole lot. SEC yield at 5.1, great. Expense ratio really low, which we like because sometimes these ETFs get up there in expenses. But Scooby Energy's place on the expense ratio alone, we trimmed it because it actually grew enough that we trimmed it back from 7.5 to 6%. People ask us, do you ever take profits? Yeah, we do that if we have a target position at 7% and all of a sudden it's at 8.5 a month later, which does happen. We'll immediately round that back to 7, and we'll take that cash, our profits, and reinvest it elsewhere, either in a new holding or add to another holding. And you'll see how we did that in DS in just a few minutes. And SGov, this is the most conservative one, near zero duration risk because it's 0 to 3 months, okay? But it's still yielding 4.8%. And that is because of the leverage involved in this ETF, all right? So this is where idle capital goes to work. 4.8% on near zero duration, which means you obviously have more risk on a bond that's 30 years away than a short-term note that's 2 months away because you're taking on more risk and you should get a higher return as well. But I'm going to say that a 4.8 return on 3 months of risk, yeah, I'm going to take that all day long. All right. In fact, this one grew as well. We had to trim this as well. So just a reminder, this is what our 3-channel buy signal, buy engine looks like. I showed you this last time. The arrow is pointing to this one troubling month here. And this month is April of last year. In fact, you can see that if you go back, look at, it's a little blurry, but look at the bottom here, and you will see that in 2023, the market went up on a buy signal and has not come back since then. Even with little downturns like today, it's just nothing, guys, or downturns like really since the 1st of March. But how do you handle this kind of month that blasts through the bottom of the channel and then closes back up well into the channel? Well, you either don't take your sell signals and risk the market making a 2008 move with clients in their 60s and 70s, or you use a different hedging strategy. And that's what we have chosen to do. So the options hedging that we've been developing and that we are able to execute, that's the key part. I could have done this at Interactive Brokers, but they didn't have the mechanism to implement this for your accounts. It's a 3% holding, but this is a little misleading. So we use 3% of your cash leverage to buy these options. But one option equals 100 shares of stock. So if we own 10 option hedges, that's not like owning 10 shares of SPY. That's like owning 100 shares of SPY. All right. And some of you folks have more than 100 of these options, which is like owning 1,000 or being short 1,000 shares of SPY. That is the hedge, because when the market is going down, you're actually going up because you are short the market, only for that portion of the portfolio. And actually, as the market goes down further and we get closer to the actual strike price on that option, that return increases more. Now, I'm not hoping that the market opens down tomorrow, and you can actually see this illustrated in your account. But at some point, you're going to make substantial amounts from these options and we'll be able to hold on to these positions, whereas in the past we could not do. All right. That's really important. Most advisors don't do this because they just don't have the technology available to them. And it's too bad. You know, it's too bad that we didn't have it. I pled with Interactive Brokers for years, but we got it done. Everybody has now moved over to Schwab, and you guys are seeing this benefit. All right. There's a lot more detail on the options hedging in the October episode last year and even in September's, I think. So if you need more information, just shoot me an email, cb3@cb3.com. I'll be glad to explain this in greater detail to you. All right. So here's the structure for GI, and then we'll all take a little break here. We added RTX, 6.4%. It's up just since the war started. All right. EEM, that diversification in international, that is EEM and EPOL, which is that Poland ETF. And then, of course, the VIX hedge. Well, it's really SPY hedge, but it's what we do to address the high VIX level so that we don't lose as much. Just to give you an example, I didn't actually check GI today, but I did check CG. The market was down 1.52% and CG was down 0.1%. So that's about a 15 times multiple saving. All right. And if the market continues to go down, it'll gain even more. Okay. So here's the summary. This is version 178. Those of you that have been with us since day one, I mean, we've had a lot of different version changes here. We're at 178. That's what we changed on the left-hand side. I've referenced all of that. What we didn't change, the satellites that we kept. Okay. And the March outlook, we still face this tariff uncertainty, the defense sector, obviously a direct tailwind from the Iran conflict, not just domestically, but internationally, international exposure with all of these emerging economies and focusing on Poland. Everything's on a buy signal. You can see at the bottom here, the holdings, equity. It's the most diversified portfolio that we have. So I'm going to pause here and get a sip of water and look in the chat here. We're on a 25-second delay, but send me a question if you have a comment, and then we'll look at DS. And yes, that is a 507% that you see there, and I will explain that. So I hear you on reserving the eating out for special occasions. That's smart. Again, thank you, both of you, for the bubonic plague. I don't know why I couldn't get that right, but one of my average shows here is about 15,000 words, I think. And sometimes I get them mixed up. So nobody better than Trump. Yeah, well, I'm not going to make political comments, but you're certainly welcome to express them here. Already talked to, hey, Rich, how are you? Didn't realize who it was. So anyway, I already gave you my opinion earlier on AT&T, but glad you're with us, Rich. Thanks. And have any interest mining company stocks? You know, that's a good point. Not at this moment, because there are just other spaces that are hotter. And we're just basically a company that's looking for growth. I mean, 2 of our 3 programs. We have 4 programs, but the 4th one's really just for small accounts. We talked about that last month. If you don't know what that is, that's MP, mini portfolio. So check that out from last month. But right now, just not seeing huge growth potential there. I could be wrong. We'll be looking at it more so now that you've mentioned it. But and we get lots of great ideas. I mean, we get lots of great ideas from our clients. I can't see everything. I have a bunch of screeners, but there are thousands and thousands of stocks out there or ETFs that we can choose. So this is DS, Discretionary Strategies, and this is since inception. You will note that it has 2 really serious downturns from 21 to 22. That was almost 42%. But it's really done well if you can stomach the downturns. And of course, that's the secret. That's why we added options hedging in DS, but not the QQQ, or not the SPY options, which is the S&P 500, but the QQQ, which is the NASDAQ puts. So there it is since inception, the 5-year return. March month to date, year to date, we're down. And that's because the rotation went away from the Mag 7 and even somewhat from the quantum stocks, not so much from AI. And so it's going to need do a little recovery here, but you can look at the chart. I'm going to come back to this actually. And you can see once the downturn happened in April, and it had a much bigger downturn, you can look below that and see the S&P 500, the gray line up 197 since inception. That's not the inception of the S&P, by the way. It's where the S&P has traded since this program had its inception. But DS had a much deeper downturn, but it also had a much faster recovery, and I would expect that to happen again this time around. So what is it? It's ultra aggressive, AI, quantum, and Mag 7. 96% equity, options, and cash. That's it. All right. Minimum investment 125. Each of our programs is 125. Just because people will say, well, I want to have some DS, but I need to put 30 grand into it. Well, you can't. You can't. There's just not enough cash to trade, $700 stocks with that amount. Or else what happens is we only buy 3 shares when you really need 5. But we don't have enough cash to do it, so the cash just sits there idle. So anyway, this is not for the faint of heart, okay? It's for investors who believe in the AI quantum era. All right, Mag 7, 62%, or just a little under 2/3 of the weighting. So that becomes the core holding. When you look at SPY at 40% of CG and SPY at 40% of GI, the Mag 7 is 62, and that varies, but it's not going to get more than about 2/3, all right? AI quantum 31, semiconductors included in that, the QQQ SPY, let's try it again, QQQ put hedge, and then cash, all right? So what did we do this particular month in review? Well, we removed Berkshire, and you might say, well, why is that in there? Well, because many people, and I was one of them, was considering that Mag 8. Well, once Buffett left, is no longer Mag 8 quality to me. All right. It may be again, but right now it's out. We reduced our size in Apple and Microsoft, NVIDIA underweight at 8.7. So every dollar not working in the best interest of the thesis, and that's why we tuned it up. So on the solution on the right-hand side, exited Berkshire, trimmed Apple, added in more to NVIDIA and TSM, just in time for a nice downturn in TSM with Trump threatening Chinese tariffs. Oh boy. But you'll see why we love TSM. Okay. So we're going to walk through each of these now. Hang with us, guys. There's less holdings here. Amazon, massive market cap. It's a testament to their exceptional strength. AWS, which is Amazon's web hosting. Okay. Amazon Web Services. They are the quiet AI winner. And because most of the inference, or that's the people that are actually employed and running systems on the AWS infrastructure, they are monetizing the entire AI economy. So Amazon's strong. It's going to continue to be part of the portfolio, of course, because it is Mag 7. Apple, same thing, although we did reduce size. All right. We never, ever fully exit a Mag 7 stock, because even if we take it down to 5%, which would be a minimum, if it has the weakest technical position and the weakest AI narrative of any Mag 7 stock, we're going to trim it. In this case, from 11.5 to 7, but keeping our exposure just in case Tim Cook finally can release Series Update that we've been hearing about for 18 months. But I digress. I'm sorry. I'm really hacked about this. I don't know if you guys are Apple users, but if you are, you got to be really upset with Apple and their total mismanagement of their AI implementation, as opposed to all their cousins in the AI space in the Mag 7. All right. Google, great company, solidly on a buy, 10.5% of the portfolio. It's the most underappreciated AI stock in the Mag 7. Notice that I said AI, not just underappreciated stock, AI stock, right? The market spent 2024 worrying if AI was going to disrupt search engines. Of course, Google's the biggest in the world, and Google proved them wrong because Gemini is very competitive. Their cloud is growing. Their search is intact. Even at a 25 PE, folks, compared to other AI companies, 25 is nothing. It's nothing. It's the cheapest of the Mag 7 tech names with a dominant AI story. We love them at 10.5. Meta at 10.5. All right. Meta at 10.5. We love it. Why? One of the most transformed companies in the Mag 7. I have a child who works for them. I'm very proud of him. And he said that their AI internal incentives are you either learn this or you're gone in 6 months. And they mean like you're spending 15 hours of your work week on this and doing everything else that you do. AI powered advertising, AI agents, they're driving their margin expansion at scale. 29 PE, yeah, it's a little high, but it's still the most reasonably valued large cap AI play in the portfolio. We trimmed it slightly, not because we didn't like it, but because we took profits. All right. So that target allocation that we have crept up because it was doing so well. So we just took it down to its target size. All right. That's the way it works when you're rebalancing. Microsoft, what a puzzling company here. The most complicated Mag 7 story. The fundamentals are strong. Azure AI is good. OpenAI partnership, of course, with Sam Altman, Copilot revenue, but the chart has just been punished. 393 is 30%. That's a bear market below its 560 high. I mean, Microsoft's in a bear market. It's crazy. All right, that's just the way it is. So we trim from 9.6% to 7% because the capital has to follow the strongest signals. And right now, Microsoft's chart is the weakest of the group. NVIDIA, the company that just basically rules everything. 14% biggest holding of all our portfolios, our largest single holding, not a speculative bet. It is a recognition that NVIDIA has built an ecosystem that competitors will take years to replicate. That is essentially what Boeing and Airbus have done. I mentioned large moat, and moat goes back to medieval times when if you had a really large moat, nobody was going to wreck your castle until they came up with cannons, and then it became a problem. And then they shot out the bottom of the castle and it crumbled, and now you have a problem. But it worked for many hundreds of years. Okay, but this particular moat with Meta, and certainly Airbus and Boeing as well, but with this moat with Meta, guys, you're never going to, not Meta, NVIDIA. As I said, when you're saying 10,000 plus words, you get mixed up sometimes, all right? This is a major moat that NVIDIA has. All right. And that's why they have a 14% position. Yeah, it's a crazy high PE. We understand that. But look at the market cap. All right. 122% year over year returns on their data center. Palantir, same thing, 9% holding weight. Just really, really strong. Maybe the most misunderstood position in DS because people say, how do we still hold this when it has a 33% pullback? And that's because of what it represents. It is in a marketplace, and yes, it's going to have these scary moves. I showed you the chart when I took a water break here. Those kind of days are going to happen, but you saw that it finished at the high, lifetime high of the program before the first of the year, and then it got hit some. And it does that every year, guys. I haven't had a single person complain to me ever about DS, at least as far as the growth. Some of them will say, gosh, I wish it didn't draw down so much. It's like, well, we address that. We're addressing that with the options. All right. So Palantir, love it. It's just a perfect play for this. And Quantum. So this is an ETF, right? 13% is our second largest holding. Not as large as a single stock, though, obviously, but 13%. It's just no longer, theoretical. Google Willow demonstrated real world capability. Quantum gives exposure to every company working on this decade defining technology. I don't think it's too extreme to say that decade defining is appropriate here. And here's how to differentiate it in your mind. At our 13% weighting, it reflects our conviction that quantum will reshape computing the way AI has and continues to reshape software. Make sense? Okay. TSM. I mentioned this earlier. TSM is the factory floor of the AI economy. Every NVIDIA GPU, every Apple chip, every AI accelerator runs through TSM's labs. That is staggering. We need to read that again. All right. Every NVIDIA, every Apple chip, every AI accelerator runs through TSM's fabs. They're fabricators. All right. Without TSM, there is no AI. And yet it's trading at a 25x when NVIDIA is at 55. So we're increasing. We did increase our weight to 9%. And I normally don't do this on a fundamental. This is normally I'm a technical trader like 98% of the time, but this is just one of those cases where this stock has to be undervalued. It has to be. So Tesla, interestingly enough, I don't think the thesis here is cars. I think it's robo-taxis. I think it's the FSD licensing. That's the licensing where Tesla says, here, buy our licensing, our technology. You can white label it and put it in your Ford or your Rivian or whoever you have and go to it. You know, definitely use ours. I don't know that it's really taken off yet, so to speak. But it will. It says, you know, it is beginning to scale. It's going to take a lot to convince these companies to have Elon Musk controlling the heartbeat of your automotive technology. Not something that Ford wants to do, I bet, or the Asian manufacturers. But if he can make a compelling argument, they may well do it. So a lot of people are hating on Windows 12. Find out why. Yeah, it could be. That new Apple, I'm going to comment on this comment I just had here. Do you have any interest in it? That's the only one I missed. So regarding that Windows 12, Apple just introduced that new laptop. You guys seen this? I do not make any money from Apple to save us, and I'm not happy with Apple. And they're just ridiculous being behind in AI. It's inexplicable. Steve Jobs would have murdered people by now. It's just crazy. But they introduced a $600 laptop that runs on a phone chip. It's not even running on one of their M chips. It's running on a phone chip. And it still beat many of the Microsoft running tablets and, you know, smaller version laptops. It's pretty amazing. So I just love seeing the technology, guys. As consumers, we're all benefactors. As investors, we got to keep with the right people. And that's why we exited Berkshire. So Greg Abel's got a limited crisis tested record. It's unclear whether his investment instincts are going to be as strong as Buffett's were. Let's face it, you don't stay in business 60 some years as the head of a major conglomerate if you don't have excellent investment instincts. So therefore, his unproven capital allocation under pressure, cultural authority, uncertainty. I mean, Buffett had a very colloquial style. He was out there drinking his Coca-Colas and answering 3-hour press conferences. I don't know whether Greg Abel's going to do that or be as compelling and as aw shucks as Buffett was together with Charlie Munger when they were doing it together, which was most of the time. So that's why we made those choices. The options hedge here makes sense to use QQQ instead of SPY. All right, it's 99%, 96%, I'm sorry, technology. So QQQ is more appropriate. You might say, well, what does this really mean? How does this play out in my portfolio? This is a screenshot from 1 p.m. today of accounts in DS. So you'll see a lot of red on the day change, right? Almost all red. All right, except for Palantir. Everybody else got some pretty big fat red numbers, except for the green line, which is the long put up 66, let's call it $67,000. Now, the short put, which is the financing put, was actually against us 35. But if you add those two together, that's $31,800 in a day. Now, we're down 0.91, but at that moment, the S&P was down 1.7. So I would like to have gotten a shot at the end of the day when the market closed at the low. And I'm sure the put spread would have been even more in our favor. So as we get closer to those puts, remember, the market's up here. The put protection is down here. We don't want to buy put protection where the market is because then we're just bearish on the market, and I'm not. What I'm trying to do is prevent tail risk. That means if here's the market, let's see if I can stay on camera, way down here somewhere. Okay, there it is risk. Okay. You guys need to be able to stomach 1 or 2 or 3, maybe 5, 6% drawdowns. All right. But you probably don't want to stomach a 20%. And when these options kick in, they tend to pick up in value. They're not uniform like stocks because they have what are called Greek components, which I'm not going to go into in this program, but there are other programs where I did. So as we actually go lower, they pick up more protection. It's a unique quality. That's why so many people that are professional traders like myself use them to hedge. All right. Makes sense. So there it is, version 40. This program hasn't been around as long as GI and CG. Exited Berkshire, added NVIDIA, Palantir, TSM, Tesla ramped up there. And there you go. 10 holdings, PureMag 7. Next review next month. So always like to end with this, who's beating who in the S&P. If you remember, we used to have a different chart on here, but this fits our color scheme for the new show. If you like our color scheme, let us know, okay? But 73% is the norm, and the S&P is actually right on target for hitting that norm, which is 73%. All right? So the winners are staples, energy, healthcare, and technology. And the losers, on the other side, not so good, right? Communication services, utilities. Not that anybody really cares because utilities isn't that big a sector. But the point is that when you see technology at 91% and the mean is 73%, that bodes really well for the future. Maybe not immediately for tomorrow's price action. But if that many technology companies are beating their forecasts, that means the quarter ahead should look pretty good if we can get the Strait of Hormuz straightened out. Okay? All right. That's the summary. Structured for the Storm is the program. This was part 2. Okay. You guys know the drill. We got a 25-second delay here. If you have questions for me, ask them now in the chat. If you are new to our program, please subscribe to us on YouTube. Click the little bell and you'll get notified whenever we go live or we upload a pre-recorded program. Follow us on Facebook, X, and LinkedIn. I tweet every single day, sometimes multiple times when things are busy. And our podcast channel remains live. Actually, I'm going to go to that first. And that's with Spotify, Apple, Amazon, pretty much anywhere you get your podcast. This is an announcement, though, to pay attention here, guys, because of travels, and I rarely travel, but I am traveling next month. So the next show is not in 4 weeks. It will be in 3 weeks. Thursday, April 2nd. Thursday, April 2nd is the next show, 3 weeks from tonight. But I'll probably still be doing podcasts from the road, so follow me there, even though we won't have a show until May sometime, right? So the most important quality for an investor is temperament and not intellect. Warren Buffett said a lot of great things, and that was one of them. It is mostly about emotional fortitude, and certainly you have to believe in the person that you've got your money stationed with, right? So here's what I'm going to suggest to you. If you know or have a friend, we're not really soliciting for new business right now, but I just feel strongly that if you have a money manager or your friend has a money manager that can't explain how they're investing your money in the same way that I just did tonight and 4 weeks ago in CG and MP, you need to fire them. What is their definition of a successful return? Risk-adjusted return. And how are they mitigating risk, especially in uncertain times with wars, with tariffs, with all kinds of economic uncertainty? Certainly the most bitterly divided political situation in America, I would say, since the Civil War. They need to have answers for you. He or she needs to have answers for you. All right. Before I say my last quote here, let me see, did I miss anything here? Mining stocks, Apple seems to be sleeping on the AFL. No kidding. That's a generous way to say it. A lot of people are hating the industry. Yeah, you mentioned that. Pretty and pleasing color schemes. Good. I appreciate you saying that. I like your handle there. It's a wrap. So we are about there. Guys, thanks for watching here. And as I always end every program, we are in this company, a faith-based company, and we believe that God has given me a calling to manage money for the people listening to the show. And if you're not a client, that's fine. You're getting educated by what we have to say, for we have not been given a spirit of fear, but a spirit of power, love, and a sound mind. And that's really important to remember, because it's real easy to get negative when the press lives on negativity, lives on it. Turn off the TV, watch my shows again. And there are other good ones. There are other good podcasters or broadcasters that are offering objective, but you have to find them. The reason it's important for you guys is because I'm the one managing your money, those of you that are clients. So here we are in Chicago. We're heading into spring in just a few days, and we have snow on Saturday. Snow coming this Saturday. But you know what? I have the best clients in the world. I have the best people in the world that watch my show. I'm eternally grateful for that. And I would love your feedback. So do remember, the next show is in 3 weeks, not 4 weeks. Do remember, you're going to get a survey link on Monday. Please fill out those answers. 90 seconds. I just need 90 seconds. Okay. It helps us better format the material so that it's most beneficial for you. All right. Take care of yourselves. Enjoy this change of season. God bless you. I will see you next time.